Inheriting real estate is not like inheriting a financial account. You can't simply transfer it, liquidate it with a phone call, or ignore it until you're ready to deal with it. There are carrying costs, legal obligations, tax implications, and often family dynamics all arriving at the same time during an already difficult period. And unlike most financial decisions, the stakes here are compressed into a shorter window. The choices you make in the first few months after inheriting a property can have lasting consequences for how that wealth transfers over time. The good news is that inherited real estate comes with some significant advantages that many heirs don't fully understand going in. And once you understand your options, the decision-making process becomes much more manageable. In this video, we're going to walk through the key considerations that matter most when you've inherited real estate, including your strategic options as an heir, how to evaluate the financial trade-offs, and what the first 90 days should actually look like. In an earlier video, we covered the step-up in basis, and this is how the cost basis of an inherited asset is generally reset to its fair market value at the date of death, and why that significantly reduces the taxable gain for the heirs who sell. If you haven't seen that video, we'd encourage you to start there because this concept is the foundation for much of what we'll cover today. But inherited real estate has a few wrinkles that are worth understanding on their own. There's a compliance layer that doesn't apply to most other inherited assets, and if the estate is large enough to require a federal estate tax return, your basis may not simply be whatever an appraisal says. It may need to be consistent with the value reported on that return. The IRS has specific guidance on this, and your CPA can identify whether it applies to your situation or not. The practical implication is that the basis documentation matters early, before decisions are made. Another important distinction involves how the property was transferred in the first place. Up to this point, we've been talking about inherited assets, property that is received at death. But gifted real estate allows a very different set of rules. Real estate that is transferred as a gift during someone's lifetime generally does not receive a step-up basis. Instead, the recipient typically inherits the original owner's cost basis, meaning that the embedded gains are carried over with the property rather than being wiped away completely. That distinction can have significant tax consequences later, particularly for families deciding whether or not to transfer property during life or allow it to pass through the estate at death. And a separate consideration involves depreciation. If the property was previously used as a rental, either by the decedent or by you after inheriting it, accumulated appreciation can create an additional layer of tax exposure at sale, even when the overall gain appears modest. A portion of the gain may be subject to depreciation recapture, which is taxed at a different rate than the standard long-term capital gains. None of these are reasons to avoid a particular strategy, but they are reasons to get the tax picture fully mapped before committing to one. Once you understand the tax foundation, the next question is what actually to do with the property, and there are more options available than most heirs initially realize. The most straightforward path, of course, is to sell. You receive cash proceeds, close your involvement, and because the basis is reset, the tax impact is often smaller than expected. This tends to be the right approach when the property requires significant capital investments to be maintained or improved, or when there are multiple co-owners with different objectives, or even when the ongoing management burden simply outweighs the financial benefits of holding. Holding the property as a rental is another option. It can generate meaningful long-term income, but it only works when the property genuinely produces durable net operating income after accounting for vacancy, maintenance reserves, insurance, and management costs. A property that looks profitable on paper can look very different once those real-world expenses are factored in. For properties that are dated but structurally sound, a targeted renovation followed by either a rental or a sale can create additional value, but only when the expected return on the renovation investment actually justifies the cost and the execution risk. There's also the option of a 1031 exchange. Under this strategy, you can sell an investment property and defer capital gains taxes by reinvesting the proceeds into a qualifying replacement property. This can be especially valuable for properties with substantial unrealized gains, where an outright sale could otherwise trigger a significant tax liability. It's a powerful tool for investors who want to remain in real estate and continue building equity without an immediate tax event. However, it comes with strict requirements. The property must be held for investment or business use, and there are firm deadlines: 45 days to identify a replacement property and 180 days to close on it. For investors who don't want the responsibility of direct managing another property, certain 1031 exchange funds or structured replacement property programs might also be available. These can provide access to diversified real estate exposure, but they can often come with limited liquidity, long holding periods, and much more complex investment structures that should be reviewed carefully before proceeding. Other options include borrowing against the equity through a home equity line of credit or a cash-out refinance, which both of these can provide liquidity without a sale. And for those with estate planning objectives, gifting or restructuring ownership among family members may be worth exploring, though, as we noted, gifting generally does not reset the basis the way inheritance does. Each of these paths serves a different purpose, and the right choice depends heavily on your financial situation, your goals, and the specific characteristics of the property. For heirs who need liquidity, selling is typically the most rational path. Equity in real estate is not the same as cash. A paid-off property doesn't improve your balance sheet in a way that you can actually spend, and borrowing against it is simply adding a debt obligation in place of liquidity with an added cost due to debt service. For those in a stronger financial position, with genuine interest in real estate as an investment vehicle, holding or renovating can make sense. But the qualifying condition isn't just financial comfort, it's operational readiness. Are you prepared to manage a property or to pay professional management? Can you absorb an extended vacancy or unexpected capital expenditure without disrupting your broader financial plan? If the answer to both is yes, a long-term hold can generate durable returns. For investors who are more conservative, where capital preservation matters more than maximizing return, the simple strategies tend to be more appropriate. High execution risk approaches like heavy renovation, significant leverage, or a 1031 exchange into an unfamiliar market introduces variability that may not be worth the upside. And for families where legacy and continuity are the primary objective, keeping a property in the family, honoring what the previous generation has built, that's a meaningful goal, but it requires structure. Informal co-ownership among heirs without a written agreement on decision-making authority, expense allocation, and exit rights can lead to long-term family conflict. Getting that framework in place early tends to preserve both the asset and the relationship. At the end of the day, the best strategy is the one that fits your actual financial picture. One of the more common mistakes heirs make is trying to decide on the strategy before they fully understand what they have. The first 90 days should be about gathering information, and there are a few areas worth prioritizing early. Start by confirming legal authority to act, especially if the property is tied to probate, trust, or shared ownership. Next, establish accurate basis documentation, including an appraisal if one wasn't already completed, since this can have an important tax implication. It's always important to account for ongoing carrying costs like taxes, insurances, utilities, and maintenance while decisions are being made. And if multiple heirs are involved, aligning expectations early around timing, use, and proceeds can help avoid unnecessary conflict later on. None of this is meant to feel overwhelming, but taking the time to address these items up front can make the process much more smoother moving forward. In our next video, we're shifting from the technical side of wealth management to something that sits underneath all of it, the behavioral side. We'll be exploring how income volatility, ambition, risk tolerance, and your own relationship with money, and how they shape the financial decisions that high net worth investors make, often without even realizing it.